Welcome, everyone, to issue number 2243, Nichols Redpath Tax Update Podcast for October 24th, 2022. This is a program produced by a couple of seasoned tax practitioners to provide current information about developments in United States tax law. Our commentary is necessarily brief. We rely on Tax Notes Today, published by tax analysts, and Checkpoint, until recently published by Thomson Reuters. Both are excellent sources of timely federal tax information and provide a lot of background for this program. What's in the program this week? The prevailing wage and apprenticeship guidance is supposed to be coming by year end. I thought we'd talk about what that might mean. Tax-exempt status of an organization that was formed to aid poor and disadvantaged individuals was revoked. Why was it revoked? Might be interesting to know that. And then taxpayers score a victory in a golf course conservation easement value case. It's interesting in that it was those seasoned commentators have suggested that the IRS made a mistake, and that's why the taxpayers won. But the taxpayers won in any event, and so I thought we would share that good news and tell you how it happened. The IRS has announced tax inflation adjusted items for 2023. I listed some of those that I thought would be of the most interest to the most people. Ian thought that would be a good idea to put a few of them in this program. And then take a look at Form 3520. Oh, what do you mean Form 3520? What is that? I never heard of it. But perhaps you should know, and we'll tell you why. And finally, can a hearing with the Office of Appeals be ordered by a court, or do you have to get there through the IRS administrative process? Good question, I think. So let's get through into this material and see what we have to work with. Tax Notes Today published an article commenting on the prevailing wage and apprenticeship guidance, which is supposed to be coming. The last guidance we had was Notice 2022-51. That was released on October the 5th. So this article comes out almost 2 weeks later, telling us that the IRS is going to give us some additional guidance. That notice explained the prevailing wage requirement that is required in various code sections and requested comments on prevailing wage and apprenticeship requirements, along with domestic content and energy community requirements for increased or bonus credit or deduction amounts. Interesting language. The IRS is smarting a bit from suggestions that they have failed to consider input from all of the stakeholders in some of this complex litigation and guidance following the legislation. So they are requesting comment on the prevailing wage and apprenticeship requirements. The apprenticeship requirement's not going to be too heavy. It's 10% of the labor union apprentices, and we'll talk a little bit about that here in a minute. The information in the notice is useful in determining how the prevailing wage guidance will be interpreted when that's applied to subcontractors and in what types of contracts. Checking the worker status for credits. How do you qualify for various energy-related credits? Well, you have to pay the prevailing wage, usually union scale, even if all workers are not union members. Now, no percentage is required, so the expectation is all of the people that are working on a project that will produce energy credits are going to be paid prevailing wage. Now, that's not the case when you get down to apprentices. The requirement to employ apprentices is 10% of the jobs that produce credit qualifying product or material. So there will be arguably, there's a limit on how many apprentices you have to employ, but they're going to have some apprentices working on producing these products. Now, only unions have apprenticeship programs. Now, there are some public education programs that have education programs, but those are not officially apprentice programs. The electricians, carpenters, the laborers, the masons, not the fraternal masons, but the brick masons, communication workers, and the Teamsters all have apprenticeship programs that you join the apprenticeship program, and then you go on the book at the union hall, and you can get called out for work. So what are they going to make? Well, they're going to make property that qualifies for the credit. Vehicles, windows and doors, heating and cooling systems, energy improvements to buildings, water heaters, insulation. All of those people, if what they make is going to qualify for the credit, the employer has to pay the prevailing wage, and 10% of the workers have to be apprentices. Tax-exempt status is revoked to this organization. IRS granted exempt status based on their representation that they would promote the construction and rehabilitation of dwellings for low and moderate income persons in their state. They're going to operate as an outreach advocacy program for youth at high risk, going to provide employment services, job training, placement, housing, land acquisition, and other programs to aid those in need. But that's not exactly what happened. This is what happened. Fancy cars, gambling, homes, luxury homes, all kinds of unaccounted for expenditures. And they didn't focus on the poor and the needy. They focused on making a profit from, what is the term, from converting the homes, from buying a home that was in bad shape and fixing it up and selling it. So they lost their exempt status. They were granted exempt status based on what they told the IRS. And that turned out not to be true when the IRS examined their operation. A golf course wins. Well, the partners in a partnership that owned the golf course, that gave a conservation easement over the property that was the golf course, have won. The Champions Retreat Golf Founders LLC, for all practical purposes, won its valuation case. The partnership's expert valuation was too high. The easement value was not de minimis, as the IRS expert concluded either. As is often the case, the court considered the information provided by experts, the qualification of the experts, the recent price paid for similar property. Here, the recent price paid for this property was approximately $7 million in 2014. In their tax filing, Champions Retreat claimed a $10,427,000 charitable contribution deduction for a easement. That's too high. The court allowed $7,800,000. The IRS expert had said $20,000 was the value because the restrictions that the owners put on with their easement was the same as they were in the land use declaration. In other words, the contribution of the conservation easement didn't restrict the property any more than it was already restricted in the land use declaration. But that expert had no prior experience. That's the mistake the IRS made. The judge took note of that and handed the victory to the partners in Champions Retreat Golf Course. One of the few cases where the contributors of conservation easements actually won anything near the value that they claimed in their return. How would you value this? Well, in reading about this case, the land apparently looked like this before they decided to build a golf course. Once the golf course is built, how would you value the land? If you value the land this way, you put a conservation easement on this land. I don't know how I would ever go about doing that, but It's one of the things that experts do. It's not one of the things, in my view, that CPAs do. I don't even think I would discuss valuing that. Now, the inflation-adjusted items for 2023. This is a lengthy revenue procedure. The code sections are presented in code section order, along with some explanation of what they do. First is the kiddie tax. Obviously, it's section 1. That kiddie tax reduces the net unearned income reported on a child's return that's subject to the kiddie tax. And the material on this slide goes on to explain how the kiddie tax works. For taxable years beginning in 2023, the maximum zero rate amount under section 1H1B1i is $89,250 in a joint return or surviving spouse. Half of that in the case of a married individual filing a separate return. An odd number in the case of an individual who's a head of household. Half of that joint return in the case of any other individual other than an estate or trust, and $3,000 in the case of an estate or trust. The maximum 15% rate amount is $553,850 in a joint return or surviving spouse, approximately half that in the case of a married individual filing a separate return, almost that much in the case of an individual filing as head of household, and $492,300 in the case of any other individual. Now that's the amount that is only going to be taxed at 15%. The first amounts we gave you, the $89,250 for married filing joint, that's the maximum amount that will be taxed at 0. Now, your income gets up to more than $553,850, or more than $700,000. That income is going to be taxed at normal income tax rates. So what I just gave you, this is the amount of income that qualifies for the special rate. Alternative minimum tax for 2023. Exemptions are $126,500 for joint returns or surviving spouse, $81,300 for unmarried individuals, $63,250, half of the joint return amount for married individuals filing separate returns, and $28,400 for estates and trusts. The exemptions then phase out in 2023 in joint returns, starting at $1,156,300. Unmarried individuals start at $578,150. Married individuals filing separate returns starts at $578,150, and they're completely phased out at $831,150. Estates and trusts, the phase out begins at $94,600, and the estate or trust is completely phased out of the AMT at $208,200. That continues to offer more relief from regular income tax on the alternative minimum taxable income. Classroom expenses of school teachers, $300. Standard deduction for 2023. Married individuals filing joint returns, $27,700. Head of household, $20,800. Unmarried individuals, $13,850. The standard deduction is the greater of $1,250 or $400 plus the person's unearned income. The additional standard deduction for those that are age 65 or over, or those that are blind, is an additional $1,500, and that increases to $1,850 if the individual is also unmarried and not a surviving spouse. Next up is the 199 Cap A qualified business income for 2023. Married individuals filing a joint return, the threshold amount is $364,200, and the phase-in range ends at $464,200. All other returns, the threshold amount is $182,100, and the phase-in range ends at $232,100. More small accounting methods for 2023. The maximum gross receipts level to qualify for various benefits under the small accounting methods of the Tax Cuts and Jobs Act is $29 million. Remember, that started a few years back at $5 million. Excess business loss for 2023. The limit for an excess business loss under Code Section 461L is $289,578,000 on a joint return, and the foreign earned income exclusion that an individual can earn working for a foreign employer in residing in another country. For 2023, they can earn $120,000 tax-free if, in fact, their abode is in the other country. More. The unified credit against the estate tax, $12,920,000. I don't have any clients that are going to have to worry about that. The annual exclusion for present interest gifts. I do have some clients that are worrying about that they're giving their kids $17,000 a year apiece. Qualified small employer health reimbursement arrangements. Your bogey there is $5,850, $11,800 for family coverage. Section 179, asset expensing rules for 2023, $1,160,000. A sports utility vehicle taken into account under Section 179, $28,900. The amount available for Section 179 expensing is phased out, beginning when total 179 property placed in service during the year exceeds $2,890,000. Now, about that Form 3520, it's used to report significant gift of money from foreign persons. Where did all that money come from? I had a call from a young man who was born and raised in India. His parents are very wealthy. He's come here to establish a business, and they gave him a significant amount of money. The phone call was, do I have to report it? Well, of course you have to report it. The question is how? And the way you do that is filing a Form 3520. And no, it's not going to get you in tax trouble. What will get you in tax trouble is having all that money, not being able to account for where it came from. If a U.S. person fails to submit this form, sanctions can reach 25% of the total unreported gift. So you get $100,000. The penalty can be as much as $25,000 just for failing to file the form. Our penalty program is working, and it's tough. The IRS enforcement efforts focused on unfiled Forms 3520 and have focused, because of all the political upheaval, have focused on financial rules that might apply to the flood of immigrants that are coming across principally our southern border. There are 6 pages to that form. It is not simple. It's a complicated form, but the instructions are clear. The instructions are clear, and they're clear in plain English. There's no reason for you not to file the Form 3520. How can I get to an appeals hearing? IRS agent audited my return. We didn't agree. We did not ask for an appeals hearing before we went to court the first time. We went to court. The issue is murky. The court ruled against us. We appealed. And in our appeal, we tell the judge, we think that everybody involved here would benefit from allowing us to have a meeting with an appellate conferee. The IRS somebody needs to evaluate the risks of litigation here because we've got a really good case. Rocky Branch Timberlands, LLC. Normally, you get to the IRS appellate conferee through an administrative process. Not this way, not asking the Court of Appeals to order the appellate conferee or the IRS to transfer your case off to an appellate conferee. Most differences get settled within that system without ever going to court. So I've never seen one of these before. That's why it's in this. We all learn things with this thing, and I'm looking at this and going, well, how does this happen? So I'm going to follow this. I don't know that it's possible or reasonable, or even that the rules would allow the 11th Circuit Court of Appeals to order the IRS to allow this taxpayer access to the Office of Appeals. And until next week, it's all for me. Ian's going to catch up. He promises.